You ever see those stock market numbers flashing red and green and just wonder who's actually behind it all? Those massive market-moving swings? Well, it's not just millions of people like you and me. Nope. Behind the scenes, there are some absolute titans of trading, and their moves can literally shape the entire economy. So let's pull back the curtain and see who's really running the show.
All right, so here's the game plan. We're going to follow the money right from the very beginning. We'll start with the company's big debut. Then we'll meet the different investors who get the first crack at it. From there, we'll zero in on the real heavyweights. We'll see how the home team stacks up against the big global players, watch their daily tug of war, and, most importantly, figure out why any of this matters to you.
So every story has a beginning, and for a company on the stock market, that beginning is almost always the initial public offering. You've heard the term, right? The IPO. This is that huge moment when a private company steps out onto the world stage and says, hey, we're open for business.
So what exactly is an IPO? Well, think of it like a company's grand opening party on the stock market. It's the very first time its shares are sold to anybody and everybody, turning it from a private club into a public company. It is a huge deal, and it's how companies raise a ton of cash to grow. Okay, but when a company has this big premiere, who actually gets a ticket? Who gets to buy those first shiny new shares? Well, it's not exactly a free-for-all. There's a pretty specific guest list. The guest list is basically split into 4 main groups. First, you've got your retail investors. That's probably you, me, folks investing smaller amounts. Then you have high net worth individuals or HNIs. These are people putting in over 2 lakh rupees. After them come the big guns, qualified institutional investors or QIIs. Think massive mutual funds, banks, that sort of thing. And finally, you have the anchor investors. These guys are basically QIIs with a VIP pass. They promise to buy a huge chunk of shares before the IPO even opens to the public. And check this out. Look at how the pie gets sliced up. The QIIs, those big institutions, get the lion's share. A full 50% of the shares are reserved just for them. Retail investors like us got a 35% slice, and the high net worth individuals get the last 15%. So right from day one, you can see the big institutions have the biggest seat at the table. So since they're clearly the biggest players in the room from the get-go, let's zoom in on them. These institutions, they are the true heavyweights. They're the ones whose decisions make the biggest waves. And in this world of big money institutions, you've basically got 2 main characters, 2 giants who are always in the scene, the FIIs and the DIIs. If you can understand these 2, you're halfway to understanding the whole market. First up, let's talk FIIs. That stands for Foreign Institutional Investors. Just like the name says, these are huge investment groups. Think hedge funds, pension funds that are based outside of India. They bring all that foreign cash into the Indian market. And on the other side of the ring, you've got the DIIs, or Domestic Institutional Investors. These are the home team heroes. We're talking about Indian mutual funds or giant insurance companies like LIC. They are registered right here in India, and they invest domestic money. And this, right here, this sets up an absolutely fascinating matchup. You've got the global guests with incredibly deep pockets versus the home team, which has this deep local knowledge of the playing field.
When you boil it all down, the difference between them is incredibly simple, but it changes everything. FIIs invest foreign money. DIIs invest domestic money. That's it. But that one little detail is the key to their entire behavior.
Okay, let's dig into this a bit. See, because FIIs are using foreign money and looking at things from a global perspective, their goals can be pretty short-term. They might jump in and out of the market, which, you guessed it, can cause a lot of volatility. But the DIIs, they're usually in it for the long haul. They're investing our savings into our own economy, which means they tend to be a stabilizing force. It creates this amazing push and pull. And that brings us to the main event, the daily tug-of-war between these 2 absolute forces of nature. This incredible balancing act is what shapes the stock market every single day. There's a nickname for the kind of cash FIIs bring to the table. They call it hot money. And why? Because it can flow into a market super fast when things look good, but it can rush out just as quickly. And that's what creates all that volatility. So that makes you wonder, right? What on earth would make these huge global players suddenly pull billions of dollars out of a promising, growing market like India's? What spooks the hot money? Well, the funny thing is, it's almost never about India specifically. It's usually about what's happening on the global stage. If the US dollar gets stronger, or if interest rates start going up in the US or Europe, it suddenly becomes safer and more attractive for them to just bring their money back home. When global inflation is on the rise, they tend to pull back from markets they see as riskier and run for cover.
And boom, this is what it looks like in real life. Take a look at the data from just one day. The FIIs were selling off big time, pulling almost 5,000 crore rupees out of the market. That kind of selling could have caused a crash, but look at the DIIs. They stepped right in and bought more than 8,400 crores worth of stock. They basically absorbed all that selling and kept the market stable. This happens all the time.
So, what does this high-stakes game mean for you and me, for the average person? Well, the ripple effects from these moves are felt by absolutely everyone, from your personal investments all the way up to the entire national economy.
Oh, the impact is massive. These FII movements can make the market go haywire. The amount of foreign money coming in and out directly impacts how strong the Indian rupee is. This investment is also the fuel for our companies and our economic growth. And what's really interesting is that FIIs often push Indian companies to be more transparent, to attract that global money, which is a good thing for everyone.
Now, you might be thinking this all sounds a bit like the Wild West, but it's not. The whole system is watched over by regulators, like the Securities and Exchange Board of India, or SEBI. Their entire job is to be the referee, manage these powerful forces, and make sure the market is fair and stable.
So if there's just one thing you take away from all this, it's got to be this. Our domestic institutions, the DIIs, are becoming an incredible stabilizing cushion for the whole market. When global panic sets in and that hot money starts to flee, our home team steps up, absorbs the shock, and protects our market from the worst of it.
So the next time you see the market is down, you won't just see a red number. You'll know to ask the real questions. Are the FIIs selling today? Is it because the US dollar is getting stronger? And hey, are our DIIs stepping in to balance things out? Now that you know who's really behind the curtain, how differently are you going to see the market's daily dance?